So in 2025, the investment giant Invesco found itself facing a crisis that was really threatening the entire industry. But in just 1 year, they managed to engineer this massive turnaround. The question is, how'd they do it, and what does it mean for the future of investing? Let's break it all down.
Okay, let's start with the big, flashy number, $2.2 trillion. I mean, wow. By the end of 2025, that's how much money Invesco was managing. It's a truly staggering figure. But here's the twist. That massive number was actually hiding a huge problem, one that forced them to make some radical changes from the inside out.
Invesco's own CEO, Andrew Schlossberg, kind of said it all. He called 2025 a year of significant milestones and transformation. And look, we all know that's classic CEO speak, right? It's code for, we had to make some huge, really tough decisions. So what exactly were those decisions? And maybe more importantly, why were they so critical?
To really get why Invesco had to make these moves, you first have to understand the massive challenge that was facing the entire asset management industry. It's this classic dilemma where profits are getting squeezed from all sides. The whole problem really boils down to this one metric: net revenue yield. All that means is it's the average fee, or the profit margin, a firm earns on every single dollar it manages. And for years, that margin has been going in one direction: down. Just imagine your company is managing more money than ever before, but you're making less and less on each dollar. That was the trap Invesco and a lot of others were falling into. So why was this happening? Well, it's simple. The money is on the move. For decades, the industry's bread and butter, the real profit engine, was high-fee, actively managed funds. But now, you, me, everybody, we're flocking to much, much cheaper passive options, like ETFs and index funds. And that shift puts this immense direct pressure on that net revenue yield we were just talking about. So you're Invesco. You're facing this industry-wide squeeze. What do? Well, they didn't just sit back and watch. They rolled out this bold, 3-part playbook in 2025, and it was designed to completely reshape the company.
The plan was, pretty simple on paper, but absolutely massive to pull off. First, streamline the whole business. Second, get your financial house in order. And third, unlock the massive, untapped potential of one of your most famous assets.
First up, sharpening their focus. This was all about getting leaner and meaner. It meant shedding parts of the business that weren't totally central to their main mission. So they sold their tech platform, Intelliflo. They restructured their huge India business into a more efficient joint venture. And they forged a new strategic partnership up in Canada. Every single move was about concentrating their firepower where it would have the most impact. Step 2 was all about the balance sheet, fortifying their finances. And the key number to remember here is $1.5 billion. That's how much they spent to repurchase a specific type of expensive debt. Now, on the surface, that sounds like a huge expense, right? But it was actually a brilliant financial move. And honestly, the best way to think about it is this. It was like they paid off a massive credit card that had a ridiculously high interest rate. By clearing that expensive debt off their books, they instantly freed up over $88 million in cash flow every single year. Not only that, but it set them up for a projected 20-cent boost to their earnings per share down the line. A huge win for their financial flexibility. And now, for the final act, the third step in the playbook, and maybe the most game-changing move of them all. It all revolved around one of the most iconic tickers on the market, QQQ, that massive ETF that tracks the NASDAQ 100. This is where the story gets really wild. Because of this strange old legal structure, Invesco was managing over $400 billion in their famous QQQ fund and earning zero management fees on it. Can you believe that? It was a giant non-earning asset just sitting there. So, in a masterstroke, they converted the fund's structure in late 2025. And just like that, overnight, QQQ went from a zero to a hero on their balance sheet, instantly becoming a core revenue engine for the company.
Okay, so that was the 3-part plan, a massive transformation with a lot of moving parts. The billion-dollar question, though, is, did it actually work? Let's check the scoreboard from the end of the year. First up, let's talk earnings. The company reported adjusted earnings per share of 62 cents. Now, Wall Street was expecting 57 cents, so that's a nice clean beat, a really solid signal that all that financial maneuvering was paying off.
And it wasn't just the bottom line. On the top line, revenue also came in strong. We're talking $1.26 billion for the quarter, which beat expectations by nearly $20 million. So yeah, both the top and bottom lines were showing immediate, positive results from the new strategy.
So where exactly did that growth come from? Well, if you look at where the money was flowing, it really tells the whole story. You see these huge inflows right where they focused their strategy. Nearly $12 billion poured into ETFs and index funds, and almost $9 billion came from their restructured China joint venture. But, and this is important, you can also see the headwind they're still fighting. Investors pulled $5.5 billion out of their traditional equity funds, which just proves that the old model is still under a ton of pressure.
So the 2025 transformation was clearly a major success. But in the fast-moving world of finance, you can't just stand still. So where does a newly streamlined and fortified Invesco go from here? What's next?
Well, it looks like the road ahead is all about three key areas. First, technology. They're building out this new hybrid alpha platform, which is a fancy way of saying they're using tech to blend the best of human stock picking with data-driven efficiency. Second, growth. They're pushing hard into private markets, investing in companies before they go public through some new strategic partnerships. And finally, shareholder value. With a much stronger balance sheet, they're planning to ramp up stock buybacks.
So at the end of the day, Invesco executed a brilliant and absolutely necessary turnaround. They are now, without a doubt, leaner, more focused, and financially stronger. They've adapted to a new reality where low fees are king. But that fundamental pressure on the industry, that relentless race towards lower and lower fees, that hasn't gone away. And it leaves us with this big, lingering question for the entire world of investing. In a relentless race to the bottom on price, is just being better enough to win, or is the entire game about to change all over again?